I think that the Bank of England has tried to condition the market that they only move when there's a new forecast. And there obviously wasn't one yesterday, so we have to wait till November the 7th. But if you read the statement, it feels like they're digging in. I mean, they obviously clearly want to have gradualism and underlined and in bold. And I think there's a reasonable case that they should go further and faster in this easing cycle. There are signs of weakness in some pockets, but of course they're confronted with service inflation being high. And now obviously with the government offering the unions bumper pay rises, actually increase in pay rises. In fact, one of the things which comes from the UK banks is that they were hoping to hold costs flat next year, and they're getting a bit nervous. Maybe they have to actually give pay a little bit more of a bump. So I think that's on the bank's mind, but I think the case for easing is quite strong.
Let's talk about some of the casualties, because we were discussing this week off camera a company that I'd been interacting with. They went into liquidation, bankruptcy. It was a gym, for instance, and we know that's a volatile industry, but it does suggest higher for longer policy is starting to impact even services, businesses. So what are you seeing in terms of those delinquencies and bankruptcies at this stage, those pain points that typically arise at this stage?
So I think it's actually, there's some similarity to the States, which you're seeing depending on where you are in the economic spectrum. If you're serving clients who are in the top, third or top half, you're in decent shape, maybe a little bit slowness. But if you're serving clients who are in the bottom 2 deciles in society, it's really, really tough. And they've had an extraordinarily difficult time for the last 3 years. And so that's partly some of the retail, some of the gyms. And so you're seeing a sort of two-speed economy. Whenever you have a central banker on here, they'll never talk about the distributional effects of monetary policy, because that's sort of verboten. But that's the problem here, is the higher rates have hurt those. And so, aggregate defaults, I think, are just modestly ticking up. But you can start to see there's some pain out there.
Huw, lovely to see you. You always say so many interesting things. I'll come back on one thing you've already said, and that was concern about the public sector wage rounds and what the ramifications of that could be. The reason I mention this again is because I actually asked Andrew Bailey about this last time round, both in the press conference and in our interview afterwards. And he was like, no, the relationship between the private sector pay rounds and the public sector pay rounds tends to be one way, i.e. it's the private sector pay rounds that affect the public sector, rather than a concern about the public sector becoming more of a problem on the private sector. Do you agree with Andrew Bailey about that?
Well, look, there's no rules which are perfect. And so all I can reflect is that talking to the leadership of the UK banks, they're getting a little bit like, is this something which we have to consider? So I'm not saying it's a hard rule, and I think we need to see, is that just after the train drivers, who else is going to get these bumper rises? So I think you need to see the fact pattern play out. I think second, though, is, and as you've debated many times, Steve, post-Brexit, the service economy and the labour economy is just that little bit more inefficient, and so it's tougher to maybe call that. I think that probably Andrew's right in terms of the governor's right in terms of the base case, but I think there's that little bit of nervousness, and with services inflation also being that little bit higher, you can see why they are digging their heels.
That's fantastic.